Have you read or heard the plumber's tale? When he gets to a customer's home, he bangs on the pipes and says, "That will be $100. The client's reply was $100. You merely banged on the pipes. Oh no, the plumber responds, knowing where to bang is another 95, banging on the pipes is $5. The following lessons are rooted in this. In which to bang. As with any investing strategy, you must establish your competitive advantage. Joel Greenblatt, the founder of Gotham Asset Management, claims that special corporate circumstances are a fruitful place to start looking. Joel Greenblatt generated an annualized return of 50% from 1985 to 1994. This is a respectable return. Sorry, I believe I mispronounced that, but what a fantastic return. This investment track record has been greatly enhanced by participation in these unique corporate opportunities that you will soon learn about. Here are the top 5 conclusions from The Swedish Investor is here to provide you with the best advice and resources for achieving financial independence through stock market investing. The Swedish Investor is reading Joel Greenblatt's book You Can Be a Stock Market Genius. Spin-offs. Observation number 1, spin-offs. Spin-offs are perhaps the first and most profitable special corporate event investment area. A spin-off occurs when a business takes a subdivision and makes it an independent entity by separating it from the parent company. In the first 3 years as standalone businesses, spin-offs outperformed the S&P 500 by 10% annually, according to a 25-year study that was completed in 1988. Additionally, the parent company outperformed the market on average by about 6% annually. Similar findings have been made by other studies. So, on average, without any skill or in-depth research, one would have generated returns of about 20% annually with a basket of spin-offs. Consider choosing your locations within this region and boosting those returns even more. The same mechanisms that allowed those returns to spin off back then are still in operation today, despite the fact that that time period ended 30 years ago. The establishments don't want them. A spun-off company may be too small for institutions to own, and they frequently weren't the primary drivers behind their stock purchases. Due to this, the stock initially experiences selling pressure unrelated to the company's operations. There is no current analyst coverage of the spun-off company. This increases the initial dumping of stocks and makes private investors wary. The spin-off's operators are suddenly given greater incentives. This independent entity is no longer tucked away in a division of its parent. This increases the likelihood of an acceleration in the business of the spun-off company when combined with greater operating freedom. Although there are other mechanisms that contribute to the spin-off's profitability, these are the main ones. The majority of Greenblatt's book is devoted to spin-offs, and he asserts that this is all that is necessary to become a successful investor. However, more options are always better. Fusion securities. Second key takeaway, merger securities. Mergers and acquisitions are another type of special corporate event, and in this case you want to watch out for the unique kind of merger securities that are occasionally used in these transactions. Typically, a company will pay the majority of the purchase price in cash and stock. However, the choice to use other merger securities can be made in order to further sweeten the deal when the acquirer doesn't want to issue more stocks or raise more money. You have a chance because, in general, no one really wants these other securities. Cans of mashed potatoes are made and sold by a company called Mr. Mash. The share price of the stock is $31. When another company, Frankie's Fries, makes an offer to acquire Mr. Mash for $39 per share in cash and an additional $4 in the face value of a 7% bond due in 2032 issued by Frankie's Fries. The shareholders did pretty well because their portfolio experienced a significant overnight return. However, what do people usually do with the money? The money part is simple, they reinvest. What about the bond, then? In terms of risk-reward, this might actually be a decent deal with a 7% annual return in coupons and $4 of face value received in 2032, but who cares? A bond? No, people own the stock because they wanted to own their preferred brand of mashed potatoes, not because they wanted to own some uninteresting bond or anything. They therefore sell the merger securities without second thought. What does face value even mean? What about the complex institutions, though? They will undoubtedly perform some sophisticated Excel calculations, such as benchmarking the yield to maturity and examining potential synergies between the two businesses. No, institutions that own Mr. Mash stock also wanted to own shares of that company, not some bond of a brand new conglomerate. Here's where you come into the picture. When handled properly, merger situations can be very lucrative, much like the dynamics of spin-off situations. Since both individuals and institutions exit the market quickly, the security trades for a significant discount to its true value, and this is where you can buy it. Third key takeaway on risk arbitrage. Risk arbitrage. Start with what not to do, as numerous admirable people and investors have advocated. This lesson will focus on a specific business situation that you should avoid, risk arbitrage, also known as merger arbitrage. Let's go back to Frankie's Fries and Mr. Mash. Let's assume that Mr. Mash's shareholders rejected the $39 plus bonds takeover offer. Frankie now decides to upgrade the bidding and pay with cash. It is currently only accepting $60 in cash. The stock was previously trading at $31 per share, but the stock market has driven it up to $58 in anticipation of this bid being accepted. A risk arbitrager will purchase Mr. Mash at $58 in the hopes that the transaction will close as soon as possible so they can cash in the $2 per share difference. Although there are many excellent ways to profit from the stock market, Joel Greenblatt believes that this is typically a bad strategy. The two main risks involved in trying this are that the acquisition may not go through for a variety of reasons, such as financial difficulties, extraordinary events following the announcement, revelations made during the due diligence process, etc. If this occurs, there would be a significant downside and it wouldn't be unusual for stock prices to return to where they were before the acquisition announcement. According to the aforementioned example, the potential upside is $2 and the potential downside is possibly $25 to $30. Time is the second risk. The process of making an acquisition may take much longer than anticipated. A 12-month wait for the deal to close would result in an annualized return of about 3.4%, which is a terrible use of your money given the abundance of other opportunities on the stock market. Again, there are many different ways to profit on the stock market. Kindly avoid risk arbitrage. Restructurings. Observation number 4, restructurings. Restructurings are an example of the kind of unique corporate circumstances you should try to understand and participate in. When we discuss restructurings, I don't just mean small adjustments, I also mean when businesses choose to sell off or close down an entire division. In fact, this occurs frequently, and if you are alert, you might notice some genuine opportunities here. A whole division is typically sold or shut down because its business isn't doing well enough. Let's say a company has 3 divisions and generates earnings per share of $4 overall, but if you look closely, which I hope you will do in these situations moving forward, you find that divisions A and B each contribute $2 in earnings per share, while division C actually reduces the result with $3 per share. The company earns $4 per share overall. However, once division C is eliminated, the earnings per share will soar to $7, which will probably cause the stock price to rise. The fact that management can now devote more of its time and energy to developing the area of the business that is most profitable, which is likely to produce better results in the future, is another factor that makes this area potentially lucrative. The decision to discontinue a significant portion of operations is frequently challenging for management because it means taking over a smaller organization going forward. For those with large egos, this is bad. You should invest in management teams that decide to close an entire division because this demonstrates that they prioritize the interests of the shareholders. Special circumstances. Observation number 5, how to behave in all unique circumstances. This final pointer is a compilation of things to consider when pursuing these unique opportunities. Some of it may be repetition from other videos on this channel, but remember that practice makes perfect. Nobody under the age of 30 should be trusted, and the same goes for anyone over 30. Actually, at 30, don't trust anyone and do your own research. You simply have no choice but to conduct your own research if you feel that you should examine unique corporate circumstances because so few others do. By using these strategies, you can outperform the competition because you'll stand out from the crowd and have knowledge that they don't. Invest with the business people. Like with any investment, you should support the insiders. Check that the management has stakes in the outcome. Using spin-offs as an example, the new standalone entity will give the new CEO the opportunity to purchase company stock, but if they choose not to, you shouldn't either. Select your areas and pay attention. Even though investing in special events can yield extraordinary returns, it is a minefield. So be sure to choose your locations wisely. When you do discover one of these gems, make it count by making a significant investment. The benefit of adding more investments to lower the risk is minimal after you have distributed your money among 6 to 8 of these scenarios. Just make sure to keep a close eye on that egg basket once you have it. It is entirely acceptable if you are not willing to make the effort necessary to research and recognize these kinds of unique circumstances. The Little Book That Beats the Market by Joel Greenblatt, on the other hand, offers a more passive investment strategy that you might want to look into. This book explains how to invest a small amount of time while still being able to take advantage of the stock market's many benefits. Thanks, guys.